Welcome to the AutoSuccess Executive Spotlight. I'm your host, Brian Ankney. Today, my guest is Richard Rodgers. He's from Dannah Investments. Welcome, Richard.
Thank you, Brian. Thank you for having me.
Actually, I should say, welcome to the Babcock's neighborhood, Mr. Rodgers.
Well, I hope you come to my neighborhood sometime down in Dallas.
I will do. Well, actually, I was just down there for the NADA earlier this year.
Yes, yeah. It was right in our back door.
Nice. Well, hey, I'd like to get started with just a little bit about you. Tell us
Sure.
a little bit about yourself, your career path, and how you got to where you are today.
Sure. So I started my career at KPMG in the Los Angeles office. And one day I went to lunch with one of my supervisors who was working for this group called the Penske Auto Group. Mm-hmm. And we spent the entire lunch talking about how I wanted to be a partner, and he spent the entire lunch trying to talk me into coming to work for Penske. So at the end of the lunch, we separated. I went and got my old beat-up Hyundai. He went and got in his brand new Honda Prelude, and I decided, well, maybe there's something to the auto industry that I should look into. So I ended up working for the Penske Auto Group for about 10 years. I taught auditing at a university for about 7 years. I worked with Galpin Motors for about 4 years, and I was an equity partner at a 5-store group in Southern California as well. I started getting to the point where I really wanted to work more on how I can help dealers be more profitable and pay less tax. Mm-hmm. Because that's pretty much what I did at my job, at most of my jobs. So I started Dannah Investment Group. I got licensed in all of the areas that I needed to on the insurance side and on the security side. And today, we focus on making companies more profitable and help them pay less tax.
Cool. Let's talk about that a little bit. So you help companies earn more money. You help mm-hmm. them keep more of their money. Mm-hmm. Let's talk about a fun strategy, healthy lifestyle. I mean, everybody wants to have a healthy lifestyle, but let's talk
Sure.
about how a healthy lifestyle can translate to a healthy pocketbook.
Sure. So there is a partner that we have that we work with mm-hmm. that has a program that will help employees generate a healthy lifestyle. So what does that mean? Well, that could mean working on things like diabetes or weight mm-hmm. loss or helping them with their smoking or stop smoking, I should say, not helping them smoke. But.
Yeah.
So anyway, what you can do is you can actually subscribe to this. Mm-hmm. It comes off of your gross wages, just through a Section 125 cafeteria plan, and allows the employee to use those funds to actually buy certain things that pre-tax that they wouldn't be able to otherwise. As a result, when they subscribe to this product, they get access to a program that's going to help them with those individual goals that they're trying to achieve. So the nice part about that is that they can spend that money pre-tax on things like their co-payments, their medical insurance, out-of-pocket costs, pharmaceutical type of things. I mean, Band-Aids. You can even use it on things like sunglasses, a massage chair.
Oh, wow.
Things that are really kind of unusual. Mm-hmm. But the nice part about that is that money comes off pre-tax. The money is spent pre-tax, and you're not paying tax on that. So from the employee standpoint, they're saving 7.65% on the money that comes out of their check. And not paying tax on that money that comes out of their check. So if they are taking out, say, $1,000 a month, they're saving $76.50 a month, and they're not paying taxes on $1,000 a month, which is great for the employee.
Yeah.
But we're talking about reducing the employer's taxes and increasing the employer's taxable income. We do that by the employer match is also reduced by 7.65%. So if we have, say, 100 employees and 100 employees participate at reducing their gross by $1,000 a month, that's $76.50 a month times 100 employees is a whole lot of money. If it was, say, $500 a month net of fees, 500 times 100 employees is going to be $50,000 in savings to the company.
Wow.
And by doing that, you're giving the employee not only a raise because you're reducing their tax liability, but you're also helping them with something that, quite honestly, everybody struggles with in some way.
Yeah. Well, I mean, if Babcock's had that program, I'd have a massage chair. I can tell you that.
We can help you with that.
Yeah. I was going to say, we were talking about NADA. I mean, by the third day of NADA, I always find my way into one of those chairs.
Absolutely. Yeah. There's a picture on their site of exactly that chair. So we can make that happen for you.
Wow, that sounds exciting. Let's shift gears. Instead of talking about massage chairs, let's talk about something that's a little bit less fun: credit card fees.
Credit card fees.
Credit card fees are kind of like death and taxes. It seems like everybody has to pay them. If you're in business, you got to pay them. But you have a solution where maybe you don't. Can you tell us a little bit more about that?
Sure. So we have a contract with with an individual that owns one of the 8 exchanges. So all of the credit card processing goes through 8 exchanges across the United States.
Yep.
And much like checks. So checks go through a clearinghouse. So because we have a contract directly with them, we're able to cut a lot of those costs out in processing credit cards. And you can do one of 2 things. You can either reduce your credit card fees or you can eliminate them. So how do you eliminate credit card fees? Well, it's by charging a surcharge. When you go and you buy gas at the gas station, there's a credit and a cash price, right? Yep. When you go to a governmental website and pay taxes, there's a debit card and a credit card price, right? The credit card price is always a little bit more. When you go to a hotel, next time you go to a hotel, you ask them if they're charging you a little bit more because you're using a credit card. The way that they can do that is if the credit card processor is the one that collects those fees. So you can't just charge more to somebody because they're using a credit card. That's going to come back to bite you. But if the credit card processor charges those fees, then you can pass that cost off to the consumer. And if they elect to use a credit card, then they will pay the fees. So on top of that, the credit card processor actually has a program where they have a rebate that will come back to the company. So instead of a credit card processing becoming an expense of the company, it can actually be a profit center. And you'll actually make money by charging credit cards. So we were working with a Lexus store in Southern California, and they were paying about $300,000 a year in credit card fees. So between the credit card fees and the rebate, they're going to save somewhere between $300,000 and $400,000 a year, just by changing their processing to this.
Wow, I mean that's a big chunk of money.
It is a big chunk of money.
Wow.
Yeah, the credit card processor has told us that they have never had a bid that they were not able to save somebody money on. Which is a pretty strong statement.
That is a strong statement. Wow. Well, in New Jersey where I live, there's very few places that take credit cards because they all want cash, but the ones that do, they all charge that fee.
Yes.
Like you go to the dry cleaner, fee. You want a pizza, fee. Like everywhere is a fee.
So with all of those people, if they're charging it through their credit card processing company, that's fine. But if they're just charging more because there's a fee involved, those people are going to be in trouble. They're going to come back after them.
Oh, wow.
So just a piece of information.
Interesting.
But you could save an awful lot of money by passing that fee off to the customer. And really, quite honestly, it's the way of the future. I mean, we as consumers understand that we're getting a benefit when we use a credit card. My wife loves the miles that we get on our American Express card so that we can go to Hawaii.
Yeah.
Right? It'd be a lot cheaper for me just to buy the tickets to go to Hawaii. But nonetheless.
Let's talk about your motto. You guys have a company motto that's really important to you. Can you share the motto and tell me a little bit about why it's so important to your company?
Sure. We have 3 rules that every employee that works for Dannah has to agree to, and that is that we make money, we have fun, and we influence others. So we make money because if we don't make money, we won't be here, right? We can't support our families. There's nothing wrong with making money. You have to be able to make money in order to survive and to continue. But you make money the right way. You don't lie, cheat, and steal. You always do what's in the client's best interest. So we have a chief revenue officer whose job is to maximize the revenue of our clients. So from our perspective, our whole goal is to improve your revenue. Remember, so our goal is for you to make more money and to pay less tax. So our chief revenue officer's job is not to sell products. It's not to increase the revenue of Dannah. It's to increase your revenue. Because if your revenue increases, then ultimately our revenue is going to increase. Number 2, we have fun. So we like to have fun. We like to do things that are fun. If you have fun in your job, then it's not work.
Yeah.
You enjoy what you're doing. So we like to have a good time. Our staff meetings are pretty, they're fun. We usually play games during them, and we do things there that are fun. Just like here, you showed me the pool table that's downstairs or upstairs. That's here because you want the employees to have fun. We feel the exact same way about that. And then number 3, we influence others. My goal is that your life is better because it came in contact with mine. So if I can do something that's going to help your life be better, whether that's financial or it's reducing your taxes, it's helping you for retirement, or it's creating this lifestyle campaign. If your life is better because you met me, then I feel fulfilled in that. So that's our goal for our employees, is to make money, have fun, and influence others.
Cool. Before we circle back into another strategy, another way that you could make my life better is if we go fishing in Alaska together. that sounds like that's a slam dunk.
Done. We should do that. We'll put on the books. We'll go. We're going to do that. Yeah, that'll be good.
So let's go. We'll go back to the strategies. You'd mentioned to me once before about a charitable donation strategy that can create income for a business or a business owner.
Sure.
Can you share a little bit about that with our audience?
Yes. So one of the things that we do is to try to help clients minimize their tax liability. Mm-hmm. We do that through 2 strategies. One is a charitable strategy, and I'll explain how that works. Yeah. So let's assume that you live in California and you're in the top tax bracket and you pay federal and state income tax. So that's going to be 39.6% federal and it's going to be 13.8% state. We'll assume that it's 50% for easy math. If you make $1 million in the year, how much do you pay in tax? $500,000, right? Yeah. Half. Right. So if you give money to a charity, right, we'll assume a 501c3, doesn't matter what it is, and you give $100,000, right, how much do you pay in tax? Well, you can write the $100,000 off. You're going to pay tax on $900,000, not $1 million. Right? And your tax liability is going to be $450,000. But when you give that $100,000 to a charity, what's your true benefit? Your benefit is your tax rate. So when you give $100,000, your benefit is $50,000, right? Because it's half. So when I give $100,000, your benefit is $50,000, and it costs you $50,000 to give that money. Now, I'm not saying anything wrong, that there's anything wrong with the philanthropic benefit of giving money to a charity, because obviously we should, and it's the right thing to do. But from a cash standpoint, when you give cash, you can write off the cash. If you give property, you can write off the lower of cost or market. So you can write off what the market value is of that property or what your cost was, whichever is less. So, or if you've held that property, you can write off the fair market value of that property. Mm-hmm. So let's assume you've got a piece of property you're going to donate to a charity. Say it's a car. You bought the car for $150,000, and now it's worth, $100,000. If you donate that in the first year, you can write off $100,000, right? Because that's what the fair market value is. If you hold it for more than a year, you can write off $150,000. But we all know that cars mainly depreciate. There's very few cars, except for collector cars, that appreciate in value. So we have a product, or we have something that is used, that is donated to charity, that has a value of 5 to 1. Meaning that when you buy this, it has a market value of $500,000. So a $100,000 purchase is worth $500,000 in value, mm-hmm. because it's been held for more than a year, and that's what the market value of it is. When that's donated to a charity, you get a $500,000 tax deduction. So let's assume you're in California. You spend $100,000, you get a $500,000 tax deduction. What's the tax benefit of that? The tax benefit of that is $250,000.
Wow.
So it's a huge return on investment, but it's also a great cause because it's given to a charity that is a national charity that, quite honestly, helps kids, mm-hmm. ultimately. And if you'd like to know what it is, make an appointment with me. I'll tell you exactly what that is, and we'll walk through the math and tell you how that will work for you. So that's one strategy we use. You can use that up to 50% of your AGI. So if you make $1 million, you can use that for $500,000. Now your AGI has gone from $1 million liability to a $500,000 liability. Make sense?
Yeah.
Okay. The second strategy is something called intangible drilling costs. So intangible drilling costs means that it's an investment in drilling in the United States. Now, I know that's a big hot topic, you know, in a lot of different places. But what's going to happen if we don't drill in the United States?
We got to buy oil from somebody that's drilling somewhere else.
That's right. So we'd be completely dependent on foreign oil. Is that good for us as an economy? No, it's not. So there's actual incentives to drill in the United States. Now, it's in certain areas of the United States, and it's, you know, there's a whole political discussion that I really don't want to get into.
Yeah.
But the reality is that there are tax incentives to encourage that drilling in the correct places in the United States. So when you invest in a drilling project that is an intangible drilling cost, you can deduct up to about 40% of your AGI. So you can invest up to 40% of your AGI into a project like that. When you do, you get a 92% tax deduction.
Oh, wow.
So 92% of the $400,000 is tax deductible.
So it comes off of your income.
It comes off of your income. That's exactly right. So 92% of $400,000 is, you know, about $382,000, somewhere in that range. So that becomes tax deductible. Now you've got an investment in this drilling project. Well, your return on the investment, right, is going to be distributions. The distributions are based on the market value of oil and the production of the oil that comes out of the ground. So at $55 a barrel, just as an example, at $55 a barrel, you can expect about a 55% return in the first year, about a 40% return in the next year, about a 35% return in the next year. And then over a 10-year period, it's kind of an inverted bell curve.
Mm-hmm.
But the reality is that 35% of the distributions are also tax-free that come back to you. So the bottom line is that you can invest up to about 40% of your AGI in intangible drilling costs. Right? You're going to get a tax deduction for that of about 92%, and you're going to get your money back over a period of time.
Wow. So with that deduction, you know, if I just to make the numbers easy, I invest $200,000.
Correct.
I'm essentially getting approximately half of it as a tax deduction. And so really, I've only got half of the skin in the game is like above my total investment is only about half of it's my money.
Yes.
But I get the return from the entire investment, even though it's only like ends up being like half of my money.
Yeah. So $200,000 is going to give you a 92% tax deduction.
Yeah.
Of which you're going to get your benefit, just like you said, in California, of 50% from your tax rate. So you're getting that money back immediately. So half of it's at risk, but you're getting paid off of all of it. You got it exactly.
Yeah. Wow.
Yeah.
I'd like to sign up. I don't live in California, but I do live in New Jersey, so it's darn close to those numbers.
I mean, even in a state like Texas, where I live,
Yeah.
there's no state income tax. It's still a great return, and it's a great way to manage your cash and to manage your tax liability. So we combine those two tax strategies together in order to really create the sweet spot. So how do we do that? So I probably should say what we do is we work with the client CPA firm, obviously, and you know the client CPA firm is the one that tells us what the AGI is, and we work with them to create what the maximum sweet spot is for the client.
Cool. Let's talk about a dealer who has been successful in their business, and now they're maybe they're ready to retire, maybe they're ready to do something different, and so they want to sell this dealership that they've created or a group of dealerships they've created.
Sure.
The government has their hand out, and so capital gains tax. It's definitely on everybody's mind. What can dealers do to avoid as much capital gains tax as possible?
Sure. So capital gains can be deferred or minimized in a number of different ways. Traditional, most people are aware of 1031 exchanges. If you have a piece of property, you can 1031 into another piece of property, right? So you've traded one piece of property for another piece of property. But there's a couple other things that you can do as well. One is called a deferred sales trust. And a deferred sales trust allows you to sell your business and your property, and you sell it to a trust. The trust sells it to a buyer. The money goes into the trust. and now you have a note collateralized by the assets that are in your trust. You can take that note in payments depending on what your goal is for the cash. So we had a Toyota store that sold. He sold the dealership for about $15 million. The money went into the trust, or the dealership went to the trust and simultaneously sold to the buyer. That money went into his trust. Now he's using that money for his retirement income. So what we can do, the benefit of that is that he's going to earn investment income on money that he would otherwise have paid in tax. And until he pulls the principal out of the trust itself, that money stays tax deferred.
Oh, I see. So the money goes into the trust. The trust invests all of the money instead of just half of the money.
Correct.
And so he gets to earn the income on all of that money. And if he can live off of that income, then he pays no taxes. But if he takes principal out, at that point he pays the taxes. But that money had the opportunity to work for him until he needs it.
Yeah, that's very close. So the money that comes out of the trust is going to be interest income. So if the principal stays there, it'll be interest income on the money that's in the trust. Well, the interest income is going to be ordinary income because that was money that's paid on his note. When he gets money back on payments from his principal of his note, principal payments on his note, that's going to come out in the same form that it went into the trust. So that's going to be a combination of return of basis and capital gains. So the bottom line is that, say you sell your dealership for $20 million, that $20 million can go into your deferred sales trust and stay there and earn investment income on all of it, as opposed to taking out the capital gains and then just working with the rest of it and paying the tax. So the deferred sales trust is a very, very powerful tool that we use on the sale of a company. The other thing you can do is opportunity zones. I mean, opportunity zones are still very popular investments. It allows you to take just the capital gain portion. So you can take the principal out, take the capital gain portion, put the capital gain into an opportunity zone, and you actually defer paying that tax until 2026, payable in 2027. When you leave it in the investment for 10 years, the investment actually comes out tax-free at the end of 10 years. So opportunity zones are still very, very popular. There's about 3,500 different ones in the United States. So we have to determine which one makes the most sense based on what you're trying to accomplish. But those are two strategies that are used that are very popular.
Well, for the opportunity zone, does it need to be another business? I mean, I guess could it be an apartment complex, or could it be rental houses, or does it need to be a retail business? Like what type of things fit?
It could be all of the above. So when you invest into an opportunity zone, you're investing into a fund. The fund is going to build either multifamily housing. It's going to build a commercial building. There was recently one that was a casino that was inside of an opportunity zone you could invest in. It could be in oil and gas. It just depends on the zone. So what happened was that the governors were allowed to designate areas of the state for development that needed to be improved and where they wanted money to be put into. They drew lines in each state of where those opportunity zones are. So when the projects were built inside of those opportunity zones, the money that went into that, if it was a capital gain, could be deferred.
Oh.
So it was really created to improve areas of each one of the states.
Interesting. I was aware of an opportunity zone. There's actually one in New Jersey, not far from where I live, that where you pay less sales tax at the retail places, and it makes sense because in that area they've just built these condos, these huge complexes. That's probably what it was.
It could be
interesting.
It could be, yeah. So they're all over the place. They're all over the country. You can still invest in that. I mean, it's a great way to defer paying the capital gain until 2026. And even when you invest in it, most of the opportunity zone fund managers, they'll give you a distribution out of your investment to pay the capital gain. Oh. So, the money is not tied up and you pay the capital gain plus the investment. They actually give you that money back in order so you're able to pay the investment, the taxes.
Nice. Well, let's talk about a topic that we hear about every time we turn on the radio, every time we turn on the television, every time, it's definitely a hot topic in the United States right now. During COVID, businesses, every business had some impact. I mean, whether it was not having product to put on their shelves, whether it was closing down their offices, I mean, it impacted everyone. And the government has programs to help businesses that were able to survive. Can we talk about, some of the benefits that are available to business owners right now due to the COVID pandemic?
Sure. So in 2020, during the pandemic, there were two programs that came out. One was the PPP loan, and one was the employee retention credit. Most people took a PPP loan, which was the right thing to do, quite honestly. It was easier to calculate. It was forgivable debt, non-taxable income. Most people took PPP loans, as was expected. But at the time, you had a choice. You could get a PPP loan or you could get an employee retention credit. It was kind of vague at first how it worked, but at the end of 2020, they decided that you could get both. You could get both an employee retention credit and a PPP loan. And so because not that many people had taken advantage of it, not only did they decide you could get both, but they expanded the program. They expanded it into 2021 for the first 3 quarters of 2021. So basically you could get up to $5,000 per employee in 2020. And I say up to because it's calculated as the first 50% of $10,000 in wages earned in 2020, or up to $7,000 per quarter for the first 3 quarters of 2021, which is the first $10,000 in wages per quarter times 70% for the first 3 quarters of 2021. So the total that you can get is up to, and I keep saying up to because not everybody works $10,000 in wages in a quarter.
Yeah.
But it's up to $26,000 per employee for 2020 and 2021. Now, there's a couple of caveats to that. Number one, if you took both, you have to deduct the employee portion of your PPP loan forgiveness. So that needs to be deducted. Number two, anyone that's a 51% or more owner and any employees related to the owner have to be deducted. You can't include them, in the calculation. And then third, it's going to be taxable income in the year that the deduction was originally taken. So if the deductions were for 2021, you'd have to restate your 2021 tax returns and possibly your personal tax returns if you have a pass-through entity. So the potential is up to $26,000 per employee. This has been a really hot topic, in the motorcycle industry, in the auto industry, in a number of different industries. There are 2 ways, and the reason is because of the qualification. It's not necessarily the calculation, but it's the qualification. So there's 2 ways to qualify. Number one is a drop in sales, and it's a drop in sales from 2019 to 2020 of 50%, or a drop in sales by quarter from 2019 to 2021 of 20%. So if you had a drop in sales, then it's a given, you automatically qualify. The second way to qualify is a business disruption caused by a governmental mandate. So what does that mean? A business disruption caused by a governmental mandate. That involves one of 2 things. It involves people or product. People are things like the restaurants that were closed. As you remember back in the pandemic, you couldn't go out to eat any place. Every place was closed. Any place where people gathered, they were closed. So those organizations, because they were mandated to close, you were allowed to qualify. The second involves product. So product is related to a supply chain. So the issue is that the supply chain, does involve the auto industry. So there was a huge shortage of cars during the pandemic. So let me try to explain this as succinct as I can. It's a cause and effect. So again, I'm not an attorney. I'm not a tax attorney. I'm making that disclosure right up front.
Yeah.
But we work with a national tax attorney that's an expert in this area, and this is how he's explained it to me.
Okay.
It's a cause and effect. So the effect is that you're not able to get inventory. The cause is that the manufacturers were unable to produce the inventory because of the governmental mandates that were put into place. So you have to be able to document both. You have to be able to document the fact that you had a supply chain issue, and you have to be able to document the fact that the manufacturer had a production issue caused by a governmental mandate. Does that make sense?
Yeah. Yeah.
So, whether cars were shipped in from overseas and they sat off on the ports because they couldn't unload them at the ports because the ports were all shut down. They couldn't have employees coming into into the manufacturing lines because they couldn't have people in the same space, or they couldn't have them in the building, or whatever the case is. That has to be documented. So the question is, how much evidence is enough? Right?
Yeah.
So who do you want to make that determination? I don't make that determination, but we use a tax attorney that's a national expert that travels the country, that lectures on this specific topic, and he gives a legal opinion as to the qualification for our clients. So basically what we do is we gather that data, we gather the information that's needed, we explain what's needed, we give that to our tax attorney, and he does two things. He creates a legal file that documents why the client qualifies and what the codes were that were created, the mandates that were put into place that created that. And then second, he creates a tax file. And that tax file is the calculation or quantification of the actual ERC credit that was done.
Wow.
So what's the benefit? Most people took PPP loans. On average, if somebody has 100 employees and they took the PPP loan, that takes out 2020, because it's about the same thing. The actuaries, the government did a great job of, you can do one or the other, but you get the same result, right?
Yeah,
you can't deduct this from this one. So that worked out pretty well. But for 2021, that's $21,000 per employee. If you have 100 employees, that's $2.1 million minus, turnover, basically. So if you take out 10% of that, it's a huge number that people qualify for.
Wow. That is a big number.
It is. So we've done a lot of these. Our tax attorney, he guarantees his work. He stands behind his work. He handles any correspondence that happens with the IRS if they were to question it. And that's the story.
Now, this question kind of goes back to the beginning. Do part-time employees, do they qualify as well?
Yes.
Yes.
Yeah, up to $10,000.
So it doesn't matter if you work 80 hours a week or 10 hours a week. It's just the first $10,000 of income.
Yes. The first $10,000 of income, and for 2021, it's the first $10,000 per quarter. So actually, part-time employees work out better mathematically because you get 70% of $10,000, as opposed to if somebody made $20,000 in a month, you get 70% of $10,000.
Oh.
And you don't get any rebate on the rest of that money, that you're paying the employee. So if you have a whole bunch of part-time employees, you actually do pretty well, with an ERC credit.
Wow. So if you had, I guess what you're saying is if I had 10 employees, I get 70% of the first $10,000 for 10. But if I had 20 employees that worked part-time that did the same job, essentially my benefit would be double.
It'd be double. Yeah.
Wow.
Yeah.
Interesting.
Yeah.
I'm glad I asked that question. That's pretty interesting.
No, that's great. That's great. The other comment I might make is that, a lot of people have been told they don't qualify, right? And that's been a common question that we have. And what we do is we connect the company's CPA with our tax attorney. And we set up a call between the two of them. And quite honestly, unless you're a tax attorney and you're qualifying based on supply chain, you really want somebody that's the expert doing that. So we have a lot of clients that are CPA firms that we handle their ERC credits for their clients for that reason alone. So they kind of sublet that, if you would. In the auto industry, you sublet work out from the service department. But they sublet that work out to us, and then we work with the client to help get that for them. And then our tax attorney takes that responsibility for the return itself. The other comment that I would make is that there are actually FAQs put out by the IRS on who qualifies and who doesn't, right? Several of those FAQs actually involve the auto industry specifically. So that money is there. It's real. We have clients getting paid a lot of money, for their ERC credits. And, we stand behind it 100%.
Yeah, it doesn't seem like there would be a dealership out there that wouldn't qualify in some way. I mean, everybody had inventory problems. Everybody had issues with customers even being allowed to come in the building.
Correct.
It seems like everything you check. I mean, everything you mentioned, dealerships were impacted by all of those things.
Correct. They were. But there's a lot of information out there. There's a lot of differences of opinion.
Yeah.
As always, The only thing that I recommend is if there is a difference of opinion, then let's let them talk to each other.
Yeah.
Let's have our tax attorney talk to the CPA firm. Let's get together. Let's come on a common ground, and let's find out why we have an issue with what it is. I even have clients that will apply for the ERC credit, and when they get the money, they will put that into an investment account with us, with Dannah. We'll put it into an investment account. It'll sit there until the end of the audit period. At the end of the audit period, then we'll collect the fees for doing it, and then they can take their money. If for some reason the IRS decides that they want the money back, it's already sitting there in an investment account and waiting for them.
Oh, wow.
So it really takes a lot of the risk out from their standpoint, and we believe in this, and so we're willing to wait, the several years before the audit period's over.
How long is the audit period?
Well, there's a difference of opinion also.
Yeah.
Right. So I've been told that the audit period is 3 years, from the date you receive the money. I've also been told that it's 2 years because the IRS has actually looked at the return. They've issued a check, and anytime they issue a check, that they have 2 years from the date you receive the check in order to file a claim against the check. So, again, I'm going to defer to our tax attorney. I'm going to let him, discuss the audit period with the client.
Well, I mean, really, whether it's 2 years or 3 years, it's a large chunk of money. I mean, for a business owner, to take zero risk and put it into an account, I mean, it's probably going to be there. But if something something crazy happens, and you really have no risk, there's no risk.
Yeah, well, I mean, to say there's no risk is kind of tough because there's always risk. There's risk in everything that we do.
Yeah.
But I think that we've minimized that risk. I think that we've prepared for what that risk is. We haven't had any claims denied. We haven't had any of them clawed back. We haven't had any of them that have had any issues. So the reality is that if you take that money, you just set it aside, now you've got a savings account. You could change your mind in a year and take the money, but if you just set it there, you leave it there, really your risk is, in my opinion, has been minimized because the tax attorney, stands behind his work.
Well, Richard, is there anything more you'd like to share with our audience today before we go?
There's one saying that I would like to say, if I could.
Absolutely.
I've got somebody that we work with that has this great saying, and first of all, a lot of people talk about, well, I don't need to do any kind of tax planning on my year-end taxes because I do tax planning. For most people, tax planning means planning on how much tax I need to pay. Tax planning is not how much tax I need to pay. It's how do I minimize my tax? How do I plan to minimize? Because the time to minimize your tax is during the year. It's not after the end of the year. Once you've gone past December 31st, most of the strategies that you can put into place are already gone. But if you plan in advance, we can use the two strategies that we talked about during 2023 to minimize your taxes for 2023. Second is that paying tax is a legal and moral obligation. But when you pay it and how much you pay is often a personal choice.
Makes sense.
So,
thank you for joining us today.
Yeah.
This has actually been a really fun interview. I appreciate you coming to Akron, and welcome to our neighborhood, Mr. Rodgers. I love it.
Thank you very much. I really appreciate it.
And thank you for taking the time to join us on this AutoSuccess Executive Spotlight. We hope to see you again soon.